Hello traders, welcome to another edition of Institutional Sunday or Institutional Weekly or whatever you want to call it. Quick favor to ask if you don't mind. I'm going to put the link up in the corner somewhere. I think over here somewhere, just above here. Intro to the channel. I've done this video, right? It's only 2 minutes long. If you do me a favor and just pause this video, go and watch that 2 minute, because I had to re-upload it. I had to delete it and re-upload it. So I think YouTube probably hasn't pushed it out. If you just go and watch that, well worth a couple of minutes of your time. Give you a good idea about what institutional trading is about, what the channel's about. Even if you follow me, still worth a watch. So go and check that out. 2 minutes, pause the video and then come back to this. Thank you very much. Okay, so appreciate you doing that. Now, I had the black pen, I'm back with my famous pink pen. Unbelievable, like literally unbelievable Institutional Sunday or weekly or whatever you want to call it today. Literally, I'm going to go put myself out on a limb here and say this is probably the best trading video on YouTube right now. We're going to be covering September performance, the week in review, upside versus downside levers in the market. We're looking forward to next week. Why do I say it's the best? I don't even think it's the best video. I think it's probably 300 miles ahead of even the second best video. It's like, why do I say that? Well, let's have a look. We've got the week ahead. We've got the payrolls broken down in ways you won't see anywhere else. We've got this table I put together, upside factors versus downside factors coming up into Q4. Really laying out the market for you, doing the dog's work. I've probably spent about 12 hours non-stop before this video, so I'm probably quite chirpy on a lot of caffeine, right? And I've laid it out for you. I've done all the work for you. You'll see all of the factors that are likely to be the upside factors, downside factors going into Q4. Some incredible data that's really going to get you set up so nicely for Q4 and put you ahead of the competition who are doing what? Looking at ridiculous squiggly lines and thinking things bounce at 50% and living in literally planet Mars, alright? I don't know what these people think. I really don't. I haven't got words for it, and half the words I'd like to use I can't use on this video. So let's actually be, in the group of people who actually know why the market moves, and give ourselves a fighting chance by being with the guys that are actually doing well in this market and consistently making money and kind of looking at the same stuff as them. Orderflow and, big picture stuff that's actually moving the market. So you can see that here. I mean, it's just unbelievable, right? So you can see why. Couldn't contain my excitement there at the start. So look, don't worry, we're going to get straight into it. First thing I want to start off with is September performance really quickly. Okay, so this is net of commissions, 27.7k. Gonna be an open book and show you pretty much everything here. So average MAE 1900, average winning trade 1900. Usually I like those to be a little bit further apart, but it was a volatile month last month, right? You can see that here. Largest gain, largest loss, very large. All my stats there, but I'll probably do a separate video on this. What it is, I've got so much to cover this week, as you've seen. I just really want to get on with it, so let's do that. Now, as always, I like to just start off with a summary of what we saw last week, and it's gonna kind of lead on nicely to breaking down all of these factors that have come into play. So we did see some weakness on Monday, right? Just continuing weakness off the back of what we've seen in end of September as part of the seasonal process, start of October. And really the first 3 days we went nowhere. We had some very strong ISM services and manufacturing data, which we're going to talk about shortly. In not a lot of detail, but it's really important. Some of those components within the data, especially the orders component, will be big for Q4 Q3 season earnings, but Q4, obviously going into Q4, they'll be released. So, but for Q3, and then Wednesday, not much happened. Thursday, massive rally, right? Big turnaround. And really, I think what happened last week, so just to summarize, we ended up up 0.8%. So caught a lot of people by surprise. You know, people talk to me about it being a short squeeze, and there was some of that going on, but actually the reality is, I think the market just came to the realization, almost like what I said in last week's weekly, that the factors that had driven us lower in September, so things like inflation concerns, which do remain, inflation concerns, rates rising, all these things had probably been overdone for the reasons that I mentioned in last week's weekly, and also the fact that Q3 earnings are now very much in play. Okay, so we got Q3 earnings coming out, which I'm going to discuss now. A lot of the stuff probably that drove the market lower, from a headline perspective, I think people realized that it was a load of cobblers, let's be honest. I talked about it last week about rates. You know, rates are still at very low levels historically, and I think the market realized that it was, and actually we saw rates rising going into this rally. So it just goes to show how fickle the market can be, and the market started to rally, I think, as sentiment started to shift towards earnings. We also had a bit of a reaction, I think, ahead of the payrolls, where people expected the payrolls to be fairly strong. And I think when you put it all together, wasn't really much to justify the sell-off apart from it just being a profit-taking exercise, a healthy rally, a healthy pullback, which is pretty much what I said last week. So this week I was buying dips, and then actually sold a little bit here and bought a little dip there. So I had a really good week, which I'll probably put a video out about later, but there's just so much to cover that I just really want to crack on with it. Now I'm going to start with payrolls, because I think that was pretty much the biggest thing last week that the market was looking at to see whether the Federal Reserve is actually going to go ahead and stick to its indication that tapering is going to start. Obviously the paring back of purchases of treasuries and mortgage-backed securities. Jerome Powell had said, and I've got it written down here, he said it would not take a knockout jobs report to meet the test, only a reasonably good report, right? And that is pretty much what we got, a reasonably good report. Okay, so I see no reason why the Fed won't push ahead and actually make it official that the tapering process will be starting in November. So, you know, I think that will still go ahead as planned. Why do I say that I think that it was reasonably good, this report? Well, actually, let's have a look at it, right? So the number was, I think it was 194,000 plus, and was it 4.8% on the unemployment rate? So a bit of a mixed bag. Unemployment rate beat the estimate, which was I think 5.1, and then payrolls came in severely, I mean kind of, I won't say severely, but quite a bit under the forecast, which was around the 500k mark, I think. Why do I say that actually, regardless of that, it was a fairly good report? Well, let's have a look at the breakdown, right? And I think this is what the market took away from this, and why we didn't see a massive sell-off on Friday is because I think once the market had a look at the breakdown, it realized that if you actually look at where the pluses and minuses were coming from, it was actually pretty healthy. I think it was like 300 and what I've got it written down here, plus 317 from the private sector. Okay, so actually it was a lot higher than the 194 if you include just the private sector. And then the government, can you see there? Negative minus 123. Okay, a lot of that was in education, so it's quite seasonal, you know, over the summer obviously teachers aren't working and so on and so forth. But Generally, private sector was fairly healthy. Okay, now the only cause for concern was the unemployment rate dropped to 4.8%, but that wasn't because of lots of people getting back into work. It was actually because the labour participation rate dropped. Okay, so labour participation rate, which is the number of people available for work, actually dropped. So that wasn't so great, and that is something we're going to see as a concern when it comes to earnings season. We're going to see if the drop in the number of people available to work starts to really affect earnings. Okay, and which leads us on nicely. I think we're going to be talking about earnings in just a minute, and I'll explain all of that as we go along. And then just one final thing I wanted to note here was average hourly earnings have actually shot up, right? And why is that? Well, if less people are willing to go to work, companies have to attract them somehow, right? By doing what? Raising wages. Okay, and that kind of has two impacts. One impact is good because obviously it means people are getting paid more and they can spend more, and that's obviously good because they can spend that back into the company, and earnings, good for earnings. But it's also a downside because it means that if earnings rise, as in, don't get confused between company earnings and individual earnings. If people's individual earnings are rising, it's negative because obviously it does cause inflationary pressures, right? And that's again one of the risks we're going to be seeing going into kind of end of this year and next year is, will inflationary pressures subside or will they increase? Obviously, if they don't subside, the Fed, why does it matter? Well, the FOMC might have to start getting much more aggressive with their tapering process and with bringing forward rate hikes, which is obviously going to be negative for the S&P. For now, we're okay, but something to just keep an eye on that. Average hourly earnings are starting to creep up as there's less people available or making themselves available to work. Something I've talked about a lot before. So let's just get on. Basically, that's enough on payrolls. Like I said, we'll keep an eye on the next report. I think it was okay and good enough for the Fed to continue their tapering process. So let's just see how that pans out. So next, like I said, I've put this table together, upside versus downside levers. I've spent probably the best part of 12 hours and I've just been noticing there is just so much information right now to kind of get your head around, and I think that's why the volatility in October has been insane. Okay, there's just so many things, and I thought, you know what, rather than just throw a million things at you, why don't I put it down into a nice little table? So I think the upside factors for the market, and I'm not only talking about S&P, I'm talking about all markets, but in particular obviously the S&P, which will drive all the other markets anyway. Earnings is going to be number one for me in terms of upside, potential upside support. So Q3 earnings being reported now in Q4, right? So I think that, and we're going to talk about that, there's real potential there, I think, because analysts seem to be quite cautious right now with their estimates. So there is potential for a lot of earnings beats to come into play. Inflation we need to be kind of mindful of, especially this week we saw crude oil, okay, being a massive factor. And in fact, I forgot to mention that, but crude oil was probably a big reason why we saw this rally as well. I'm going to flick around a little bit here. Let me go and show you something I put together with crude oil. There you go. Can you see crude oil here? Hitting like serious highs at the moment, just below 80, I think, just above $78 we're seeing. Can you see this? Crude oil and really starting to drag the S&P with it this week. So I think that was a massive factor, something to keep an eye on. Why is that? Well, if you look at energy, right, it's been really outperforming. So obviously when oil prices go up, energy sector does well, helps all the energy companies in the S&P, so that's been quite a good thing. But the downside is inflationary pressures, and obviously that can impact consumer demand. But at the moment it's been okay, right? We're used to seeing 70, 80, even $100 oil prices. It's really if it starts to get really out of hand. But obviously, like I said, this is for the whole of Q4, something to keep an eye on. Okay, inflation. Upside factor, strong demand. We have seen very, very strong demand from consumers as the economy normalizes, right? COVID restrictions being taken out. A lot of that demand feeding through now as consumers are really starting to get back to normal kind of spending levels. But the only kind of counter to that is that a lot of that spending has been in goods as opposed to historically services. Okay. And what that means is that, why is that? Well, people are ordering a lot of goods, aren't they? Rather than going out and participating in services, they're actually ordering a lot of goods to their home, aren't they? We all know that. Stay at home, work from home, order goods to your house. That's why a lot of manufacturers are seeing just crazy levels of demand, which is driving up their input costs. Their demand for energy has gone up, and that's why we're seeing oil prices go up a lot this week. So can you see it's a very fine balance, and you as a trader need to be able to have a good feeling for, is the market more worried about one upside factor versus the downside factor and so on. And that's really what Institutional Sundays is about. Other downside factors we are going to just briefly touch upon are labour shortages. I talked about it just now. Do you remember I said labour participation rate? That's why the unemployment rate ironically dropped, because less people are willing to go back to work. So companies are really struggling to hire at the moment, right? So labour shortages will impact earnings, right? If you have, 100 people who want to buy goods from you, but you ain't got the people to make those goods for them, that's a problem, right? So supply chain, labour shortages, input costs are going up. And one other positive factor on this side now is above trend GDP. Obviously, like I said, consumer demand is strong. GDP is strong. Economy is growing very, very well, being driven by various factors, but obviously the consumer being always, as usual, the main factor. Downside factor, potentially rates going into Q4, we'll see. At the moment, I've obviously said I don't think it's that big a deal, but if rates start to rise significantly, it could be an issue off the back of higher inflation. So we'll have to see whether that comes into play. Another positive is stimulus. Ultimately, even though the Fed is tapering, they're still providing stimulus to the market. So obviously that's positive. And the final negative is the government debt ceiling. Okay, so which has actually resolved itself, at least in the near term, which obviously was a positive this week as well. So, maybe print this out and put this on your wall, right? These are the upside factors at the moment, which I believe outweigh the negative factors, okay? For now. But if any of these negative factors start to come into play, right, over the next quarter, things like inflation, supply chain, right, rates, issues with the government, debt ceiling, and obviously government spending. We avoided the government shutdown recently. If any of these levers start to ramp up soon, then obviously we're going to be having some headwinds, right? So what I want to do today anyway, right, is we're going to go through all of these as the following weeks come along. The ones I want to focus on today are earnings and inflation. Okay, so let's crack on. Let's basically start with earnings. Q3 earnings season being reported in Q4. Always a bit of a mouthful, that. So I showed this last time, right? This is an updated version of Q3 earnings estimates. So Q3 earnings estimates, if we look closely, towards kind of August, we saw a slight ramp up, but they've actually been quite flat. Okay, so analysts have pared back, at least in terms of their punchiness, what they think earnings are going to be for Q3. Still very healthy levels, obviously, just under 49 dollars per share. This is EPS, earnings per share. For the S&P as a whole, still very, very healthy numbers, but you can just see in the past we've had big ramp ups going into the kind of season, going into kind of the announcements. Here you can see it's just flatlined, right? And some of that is because of these supply issues, supply bottlenecks, input costs, right, which is also part of supply issues, input costs, and labor shortages. I think these are going to be things you hear about a lot going into Q4. You'll hear this being described a lot. Okay, that's going to cause a lot of volatility as earnings come out. Do earnings matter? I think they're everything, right? And let's actually have a look here. If you have a look at companies that have had positive revisions, right, since 30th of June, right? So really here, if you see that, earnings have been slightly pushed up in terms of estimates. Companies that have had good revisions have performed well, okay? Companies that have had downside revisions have performed poorly, right? Almost 100% correlation there, right? I'm probably exaggerating a bit. I don't know if it's 90 or 100 or whatever, but basically you can see earnings are absolutely everything. So going into the next, I would say, few weeks as Q3 earnings are reported, the market is absolutely going to be focused on this stuff, and that's why I think the market had that turnaround last week as it realized, okay, you know what, a lot of the stuff from the past is now getting out of the way, and now going forward we've got this to deal with. So some interesting facts and figures going into Q3 earnings season this week. We have had some companies reporting already, and in fact it's very interesting. Like I said, I'm going to jump around a little bit here. Of the companies, right, this is really interesting chart I found. Of the companies that have already reported, I think it's 21, right? So just a few companies that have reported. I found it on FactSet. Look at what they've described as issues that have had a negative impact on earnings. Supply chain, labor costs, right, and COVID, obviously. The two things that I have talked about, right, supply chain disruptions and labor costs, right? So here, supply chain and labor shortages. So you can see very, very much going to be a downside risk. Having said that, in terms of the actual earnings number themselves, looking like it's going to be another very, very punchy period. Let's have a look at recent times. Earning surprises. So beats, basically. Have they beaten the estimates? Average is around 5%, right? In terms of earnings beats. What have we had this year, right? This year we've had some crazy numbers, like 20% numbers, right? Look at this, percentage of reported earnings above estimates going into 2021. Almost 90%, right? Now, the thing that I haven't read about anywhere, but what got me thinking is, if analysts haven't ramped up their estimates, can you see the room for some serious beats is high, right? So the risk is that we actually get much better numbers. Now, I don't think we're going to be able to match kind of these type of numbers, an average of, I think, you know, we're already last quarter, we're up at almost 90%. I do expect that to fall off, but you know, maybe to these levels or whatever. It's still going to be a very positive season, I think, for earnings. Why does any of this matter? Because if it's a positive season for earnings, it's going to be a positive season for the S&P 500. Look, we see that here, right? S&P 500 will track and react positively to positive earnings beats and negatively to negative earnings. So downsides versus surprises. So very, very, very important, okay? Another reason, not only because analysts have lowered their estimates, do I think the upside surprises could be positive, plus obviously continuing the trend from this year of earnings. The other thing is, let's actually look at the underlying data. You know, when do companies make money? Companies make money when people buy their stuff, right? People are buying stuff in droves right now. Like I said, the economy is coming out of COVID restrictions. People are buying stuff, basically, and we can see that here. If you look at the ISM number that got released recently, if you look at the new orders component, right, massively positive, massively above neutral territory 50. It's massively positive. And if you actually correlate that or chart it against upside earning surprises, which is this, right, this here, but in line format, can you see the correlation between the two? New orders and earnings. And it would be, right? Because obviously if people are buying stuff, companies are making earnings, right? And it's not rocket science. Basically, if new orders are up, which they are, earning surprises tend to be up. So people are buying stuff. Obviously, the mitigating factor to that, as I've already said, is supply chain disruptions and labor costs and shortages. We'll see, okay? If earnings do perform not as well as expected, I expect a lot of companies to be using these as the genuine excuses. I'm not saying they're not correct, but these are the things we've got to keep an eye on. I'm going to be keeping an eye on. Now, one final thing I want to talk about before we wrap up, very, very important, and I'm going to be keeping an eye on this, right? And we're starting off with, and I've got it written down here, we've got JP Morgan, BlackRock, Bank of America, Morgan Stanley, Citigroup, Wells Fargo, Thursday, right? Goldman Sachs Friday. So basically financials, okay? Financials, okay? Huge chunk of the S&P. Return to date has been 30.9%. Why is this important? Okay, well, let's have a look at, what drives banks' profits. If interest rates obviously go up, that's typically good for them because they're earning more money, right, on loans and whatever else. We've seen interest rates rising, especially at the 10-year, 30-year rates going up. So what we're seeing is the 2s, 10s yield curve steepening, okay, basically rising, and that's very good for banks, right? And that's driven by the back end, so the 10-year, and that's going to be driving banks' profits, okay? So another reason why, even though rates were rising, we saw, as in during this period, we saw yields starting to ramp up. The S&P was actually seeing this as very positive. I think the S&P investors have an eye on next week. Financials are going to be reporting, looking like it could be quite a strong period for them. And obviously the expectations even going forward is going to be very strong. The other one I wanted to just talk about was energy. So you can see that here. Oil prices obviously rampant right now. Part of that, as I explained, is global demand is very, very high. Partly because, like we talked about, as the economy has shifted, buying patterns have shifted, and we're seeing a lot of demand for goods, right? Versus historically we've been services driven, right? Consumers or GDP has been driven by services demand. Right now we're seeing goods demand. What does that mean? Manufacturing companies who make goods have this big demand for energy, right? And obviously there have been some supply issues as well, OPEC and so on and so forth, which I won't really get into, but they have been a factor, also driving up oil prices, right? So that's good for the top two sectors that you see here, and that's why these sectors have been performing so well, right? Important sectors driving the S&P up and forward, and the fact that financials are starting off the earnings period, wouldn't be surprised to see a little bit of a supportive week next week for the S&P, which could catch shorts by surprise, right? If people are expecting the market to sell off, could get some trapped shorts in there, don't know. We'll obviously have to see how that plays out. Just finally, week ahead before we wrap up, earnings, like I said, is going to be massive, right? Earnings Q3 earnings will be absolutely massive, and you don't see that on a calendar, right? Unbelievable how many people don't look at this stuff that is not on a calendar, right? And it's all available. Obviously, you just got to put in the research or watch Institutional Sundays, where I do it all for you. We've got inflation number, which is going to be quite interesting, coming in. You know, inflation is looking like it's staying quite punchy, even though the Fed keeps saying it's transitory. It's looking like it's quite punchy, and obviously with energy prices, we've seen in the UK, Europe, gas prices going completely bananas. Oil prices, obviously, as you just saw, going crazy. You know, it's keeping these things elevated. So I think that will be quite interesting. The market will be looking at that. Obviously, if inflation stays elevated, rates, interest rates, will likely start to push up again. So, you know, there's a fine line between, rates being pushed up and it being a good thing, because obviously it helps certain sectors to earn money and has a positive impact, like we talked about with the financial sector, and obviously where it starts to hurt consumers. We're still at very low levels of rates, but obviously, you know, these things will drive even future expectations. So very, very important. Looking at inflation numbers, PPI as well. So two sets of inflation numbers coming in, and then retail sales, which is expected to be a little bit negative going into the month. So those are the three things I think that the market is going to be looking at. One final thing, inflation, I had here. I've already talked about energy and so on and so forth, but the prices paid component of the most recent ISMs, still very, very elevated. So like I said, inflation is a big risk, right? As is some of the other factors I talked about, the supply and labor shortages. These things will be factors you're going to hear a lot about in Q4, okay? Along with obviously the positive factors. So I hope that was useful. Subscribe to the channel if you found that useful. Click the button there. I'm going to put the subscribe button there. Have a great week. See you soon.